This is Efrem Hoffman broadcasting live from NakedSwanTrading.com out of Midtown Toronto, Canada. I'm here this evening to discuss a very precarious situation that is pressing on the markets going into the coming weeks and extending for several months and even a few years. This event is going to change the way people look at the financial markets for a very long period of time. It's now Q2 of 2012, and pretty much the same economic and research intelligence that enabled me to foresee the subprime crisis, as well as the housing bubble and many crashes in advance over the period of the last decade. And not just see those events, but see them with specificity several years and in some instances months in advance, with exact attack points in terms of how volatility and price would maneuver over an extended period of time. And basically, what I'm seeing right now is an event that is going to overshadow any of those events I have seen during the housing bubble, that I've seen during the subprime crisis, and it's going to be a convergence of a number of factors that are going to cause a market crash. And therefore, I'm here today to actually issue a market crash warning for the global economy. It's going to hit the United States extremely hard, as well as Europe, and affect emerging markets as well. The key indicators that I look at that is telling me the big picture is moving in this direction is basically the spreads between junk bonds and high-grade corporate debt. Okay? And what's happening here is that normally junk bonds should be performing rather poorly as you go into a negative environment, and high-grade bonds, at least from a forward-looking perspective, should hold up relatively well. But what's actually happened over an extended period while the Federal Reserve was keeping rates exceptionally low, and the bonds right across the spectrum, the yields moved to such low levels that it was hard for anyone to actually get any yield to stave off inflationary pressures that could hit us down the road. So as a result, many people crowded into high-grade corporate debt, which is the symbol LQD. And basically, because of this, and it wasn't just high-grade corporate debt, it was also high-yield instruments, it was high dividend-paying stocks, income trusts, all these kind of things, and even real estate investment trusts. And essentially, a lot of the hot money that the Federal Reserve pumped into the system drove those prices of those asset classes up. Okay, but what's about to happen is a mass unwinding of those asset classes. And even though junk and high-grade corporates should be diverging significantly, what you're going to end up seeing is a very large-scale crash in the high-grade bond market over the next couple years, and it actually started a number of days ago, and we actually issued a number of alerts on Naked Swan Trading, and basically on our website. If I scroll down here, you could actually see some of the calls and some of the critical alerts that we actually put out. And we provide weekly free webinars for people who want to get updated on these critical events as they unfold. And basically, the other issue that I'm really concerned about right now, that is also pointing towards a stock market crash, is the fact that the spread between government bonds and also some of, not just, it wasn't just the high grade debt, okay, where there's a problem, but it was also in foreign bond markets where the yields in terms of emerging markets are going to be impacted as well. And for example, the symbol is PCY. PCY represents emerging market sovereign debt, and it right now appears to be on the precipice of imploding. And that certainly is not a good situation. Now, why might that be happening? Well, if you take a look at a lot of the countries around the world that were doing fairly well when money was floating all around in the first quarter of the year, basically since then there was a very rapid slowdown in India and in China. So essentially you've got 2/3 of the world's population, you know, kind of stalling out in their need for commodity products and infrastructure development. And two of the biggest beneficiaries of that is Australia and Canada. And both of those areas have been in an extreme property bubble. Canada alone has a property bubble that exceeds the values of what the property bubble was actually in the United States at the peak, and actually exceeding it in some cases by up to 40%. In such a situation, what's going to end up happening, because of the curtailment of the need for those commodity products for which commodity producing countries like Canada and the Aussie are central to, you're going to see huge movements in the values of those currencies relative to the US dollar, which is going to put an artificial bid in the US dollar, even though the US owes a tremendous amount of debt. So because all of the stock market indices are priced in US dollars, as well as commodities and energy, that's going to put pressure, downward pressure on anything priced in dollars, including stocks. And it's also going to create a tremendous problem for Canada and Australia. And the EWA, which is the Exchange Traded Fund for Australia, as well, and also the Aussie US dollar cross rate currency, appears that it's on the precipice, and I've issued a warning to that effect on the Twitter feed, and you could see that on the side of our web page over here. And basically what that's signaling is about a 20% very, very quick crash in the Australian dollar, and it's going to extend for quite a long period of time into the coming years. And as well, I'm also expecting upward pressure in the Canadian dollar relative, upward pressure in the US dollar relative to the Canadian dollar, okay? And this is going to put tremendous pressure on the Canadian banks, which happen to finance a lot of this property bubble that took place in Canada. And the same problem is occurring in Australia, where you had a lot of the banks finance their property bubble. So you're going to see a drop in the order of 60 to 75% in the big banks, especially potentially in Canada. TD, Bank of Nova Scotia, as well as Bank of Montreal and the Canadian Imperial Bank of Commerce, is going to be under extreme pressure. Okay? And those were the safe havens in the world where people ran during the last crisis. So there isn't really going to be any country to hide in. Okay? Also, you've got the periphery countries in Europe that are going to go to the wayside, as Spain is on the verge of collapse. We put out a critical alert a number of days ago. Most of our alerts came out in May. Our first alert for the real part of the crisis really came in with our pilot light indicator for the whole crisis being Apple Computer. And basically we gave a warning back on March the 30th that when it was in the 630 price range, that as it got underneath 633, you would see a mass exodus of capital out of Apple, triggering a worldwide crisis of confidence, which would spread through the tech space and then hit the rest of the markets. And it's not that Apple was the only bubble. There were many, many bubbles in many, many different stocks right throughout the industrial complex in the Dow, as well as in the utility area, high-paid dividend stocks, as well as in, especially in chemicals and the S&P insurance sector. And a couple of the areas that have actually held up fairly well this year, such as consumer discretionary and consumer staples, as well as international consumer discretionary prior to this sell-off in the March-April period and escalating in May, those have held up fairly well. But what I'm seeing is major bubbles that are ready to pop as we progress through the year. And they'll be taking them down one by one. But those are going to be the last components standing. So while everything else starts collapsing, those will collapse one by one, and then eventually by the end of the year the whole thing will give way, and there won't be one asset class. From real estate to bonds to fixed income, doesn't matter what you pick, as well as currencies. And we all know that when there's major movement in the currency market along with movement in the corporate bond market and the stock market at the same time, that leads to extreme crashes of the type and speed that we saw in 1987, except the duration will be much more severe. It won't be like a 1 or 2 day event and then a snapback and 3 months later we approach new highs. This event is a multi-year event, and it could be decades before we actually see any material improvement in the market, very similar to how it took decades to get a material improvement as we endured during the 1929 and the 1930s period after the crash. Okay? These are very different times. Obviously, in the late 1920s and 30s, the problem of debt was in the private hands. Okay? Today, the debt is in the hands of the governments, which make it much worse, because the majority of the people today are relying on Social Security and all kinds of Medicare packages in order to survive in this world, which is going to be heading into higher inflationary pressures as we come out of this crisis. Initially, there's going to be obviously a deflationary depression with this kind of situation unfolding. And due to that effect, it's going to be extremely difficult for the government to do anything about it. And the very few people that are extremely wealthy in the world, where there's a lopsided wealth effect, yes, they're going to have a capital, but they're not going to really be able to, get the necessary services that they're used to, considering that there's going to be so many layoffs and a lot of changes going on in the political front to respond to these financial and economic stresses. Now, some of the other areas that I'm eyeing right now is also the healthcare index. There's a healthcare crisis. Medicare inflation, for example, right now, the index is far outpacing the CPI. Brand name drug price inflationary pressures are far exceeding the Medicare inflation index. And this is one of the leading causes of bankruptcy in the United States, not being able to pay medical bills. Okay? And with the crisis worsening, and with the great influx of people going into, workers going into the healthcare space, once that bubble pops, there's not going to be support in the actual job market as we saw during the Great Recession of 2008 and 2009 that's going to be able to support that. So it's good. So when this next episode of market meltdown occurs, in which I believe will hit very, very hard the XLV, the healthcare index, and exceptionally hard, it's going to hit the big pharma index, the IHE, as well as the XPH. Okay? And medical device technology companies like ISRG, which we put a very critical alert out when it was rallying into the 592 area earlier in the month, and we indicated that there would be an enormous drop, and it's still continuing, and we're already down in the lower 500 area. So, you know, between Apple and ISRG, you're talking about 200 points of damage, and it's not even the end of the month, and we haven't seen anything yet in the space. Also, Humana, HUM, you should really be eyeing that symbol. It looks like there's going to be a continued mass selling. Our initial signature there was at 90. It's heading towards 66 rapidly. And then, of course, there'll be some bounces along the way, but lower prices as the year unfolds. National Health Investors, NHI, is another one that initially was up in the 50 area, and it looks like it's heading down to about $19. So it's another one that is showing that it's falling off a cliff. Healthcare REITs look like they're going to tumble, like HCN. S&P dividend ETFs like SDS as in Sam, D as in David, and Y as in yellow look like it's actually going to fall off a cliff. Builder bonds, BAB, it looks like it's going to be falling off a cliff. High yield corporates, HYD, is in serious trouble. Its associate, PHB, looks like it's in serious trouble. Junk bonds and low-grade speculative debt, JNK, serious trouble. And high-grade corporate bonds, LQD, in serious trouble. The PIMCO Broad U.S. Treasury Inflation Protection Securities Index looks like it's going to have some trouble. And you would wonder, because you would think, well, what does that mean? Is it saying that there's actually deflation coming first? Or is it saying something else? Is it saying that Treasury inflation protection notes are not really the best way to hedge against inflation? Why? Well, because the inflation that affects us goes beyond the CPI index. And the CPI index is what Treasury inflation protection securities are tied to. So people that are going to eventually try to get protection against inflation by going into TIPS is going to be in for a big surprise. Again, no safe haven. And even if there is a small movement up in the short term, it's a bubble ready to burst. Okay? And also, when you have this many asset classes all breaking down at the same time, there's going to be extreme margin debt problems. And, you know, usually what happens is in the afternoon hours, when people are overexposed, there's forced liquidations in securities that they normally wouldn't sell. So even securities that aren't in a bubble, very few and far between, will be impacted severely by the liquidity crisis to hit the rest of the market. Also, there's this index called the GWL, which basically is everything outside of the S&P 500 for the rest of the world, and it looks as if it's ready to crater. Regional banks will underperform. KRE index. Credit Suisse looks like it's in serious trouble. And also, because of all this trouble in the corporate bond market, a lot of the credit default swaps that a lot of the big banks are trading, and possibly even JP Morgan and possibly even Credit Suisse, if they are trading in those and betting that there's going to be not such a bad fall, they're in for a surprise. We're talking about one of the biggest falls since the 1970s, and possibly that index going back to where we were before the 1987 crash. So we're not just talking about wiping out the past decade, but we're talking about wiping out the entire bull market that started in 1982. And there's this index that very few people know about, but it's extremely good at identifying major market meltdowns. And even in the crisis of 2008, it didn't even have a signal anywhere near what we have right now. In 2008, I was looking at this index called the Dorchester Equity and Corporate Bond Index. It is the most elaborate index covering about 80% of all securities traded, not just the securities traded in the Dow or the S&P 500. It even extends way beyond the securities that trade in the Wilshire indices, which are fairly broad and deep. And this index is often used by the Federal Reserve to actually investigate, to do a forensic analysis of what's going on in the economy. And basically what it was signaling in 2008 was that, well, yes, equities and bonds went down, but the bond market didn't really have a major signature that showed that it would stay down for the count in that short period of time. There was a sell signal in the equity market, but when you look at the broad-based equity and bond index, the CPM KTE Dorchester Index, it is now signaling a complete reversal of fortunes going back to where we were in the 1990s, the early 90s. So we're talking about reversing every gain that we had since that period, and we're likely going to be seeing downside activity in the market in waves. And as the first wave you're going to see going into, or accelerating like into the end of May and the first week in June. Then there's another big wave that hits different sectors in as you progress into the middle to the end of June. Then you've got a situation going into the middle of July for some sectors. And then, of course, yes, of course, when you fall that much, you could have a natural retracement in the market, but it's not what people are going to be thinking. It is not buy the dip mentality. This is basically a trader's market, and treacherous at that. It makes more sense in this environment to just wait for a little bit of a retracement. You could come to our website at nakedswantrading.com or follow our Twitter feed, and we'll be updating it live with critical events that will tell you precisely when we see any retracements rolling over. And we see almost all those retracements rolling over in earnest. And August is going to be a very dangerous period because any retracements that take place would form rolling tops in August, and many sectors rolling over in the September the 23rd to the 26th area to start. And that will lead to a massive crash in all sectors going after the first part of December right through May of next year. And that will be the most devastating crash I believe anyone has ever witnessed in the history of financial markets in the United States. And I am quite sure of this based on all of the indicators that I look at. Energy stocks like ExxonMobil, which are huge capitalization weights in the index, are being pummeled right now, and we gave warnings almost $8 higher than where it is right now earlier in the month that it was going to start rolling over for an extended period of time and crash. MOV, Mary over value. MOV is an oil trust that looks like it's on the verge of collapse. Okay? So we're talking about so many areas that were driven up by the Fed money pumping that are going to go down. And a lot of people think, oh, well, the Fed's going to come to the rescue and everything is going to be fine. Well, you know what? Everything's not going to be fine in the beginning. And the best way to actually deal with the problem is to let the problem take its natural course, not do what the Fed did every time there was a bubble, and just because things got a little bit bad, and I have to admit they got terribly bad, but it's because of a lot of the policies that were imposed over decades, and a lot of the foolish spending in part of the average citizen. And what has really happened in the political world over the past number of years is that we started off everyone for themselves, then it became a G7, then it became a G8, then it became a G10, then a G20, then a G30. And you know what happens? In game theory, when you start approaching a G infinity or G the world, nobody takes anyone seriously. There's so many different parties. It's like having a government meeting, people getting together in a boardroom and saying, hey, we're going to discuss issues going forward. Yeah, all that ever happens at those events is that, yeah, you just read off the issues and nobody agrees on anything. So what has essentially happened over the past few years is an economy that started off as G7, going to G30, and now we're back to G0. And G0 is basically a world where nobody agrees on anything. And the problem is that back in 2008, Europe wasn't in such shambles. It was the United States that was having the problems. Today, the United States didn't even get rid of the last problem. We just basically added debt on top of the problem, and now it's coming back to haunt us. But because of that and other factors, the European markets are now also in the same predicament that the U.S. was back in 2008, and worse in many of the periphery countries, and especially Spain. And, we gave a warning that Spain ETF, EWP, is going from the mid-20s down to $5. And who knows where it's going after $5. So what this is really signaling is an end to the era of manias. And I believe that there won't be any bubbles left after all these things pop. And that will be good for the very long term, but it could take decades to actually build ourselves out of this and come out much stronger. We will come out stronger. But the idea is, what do we do now in order to protect our assets from the coming deflationary depression and then the reflation and potentially hyperinflation that follows in the second part of the decade? And what I suggest is we do what people did successfully back in the 1920s. Anyone that survived that knew that over the period while there was a mass unwinding, and deleveraging of assets and asset bubbles, it was smartest not to invest in an asset, trying to find or search for yield. It's best to just accept the fact, do nothing is the smartest thing. Okay? And this is not a recommendation because this is just for research purposes, but based on my understanding, I would basically do nothing. And do nothing means that keep the powder dry so that when the hard rains land on the ground and there's blood on the streets in the financial markets, and it's then time to potentially picking up the stronger sectors that didn't fall as much in the financial crash, and even though all of them are going to fall a significant amount, there's always certain equities that are more resilient than others, and we're going to try to pick up those pieces. Now, unfortunately, the earliest I could see even thinking about trying to pick up pieces where there could be a sustainable rally for a period where you could actually trade it and expect, to make a sizable potential profit wouldn't be at least until Q2 of 2013. But then again, I do believe that we will be revisiting another rolling crash possibly again in 2014. So I would think sometime in 2014, possibly 2013, we'll have a basket of securities where we actually see some large retracements. But you got to remember, when an equity falls 50 or 75%, going up 60% does not recover you back to the highs. So unless you're trading the market for these large-scale moves, buy and hold is certainly not going to work. And on top of all this, and this is the really scary thing, is that we've got a U.S. fiscal cliff about to hit the market at the end of the year. And basically that means that there's going to be rising tax rates on investment profits. Well, I guess there's really no need to worry about that, since possibly by the end of the year there won't be any investment profits. However, it still will impact traders that are going short the market that happen to amass great gains. Okay, so that may cause some capital flight out of the United States. There's another issue that's going on where there could be a liquidity credit crisis exacerbated in Europe. What I've noticed also is that the LIBOR rates obviously are coming down in Europe in order to stave off the problem. Rates are already low in the U.S., but on a relative basis, that's causing the U.S. dollar to go up. And what's going to happen is, due to the dangers that people are perceiving in the European countries, as well as the lower LIBOR rates that U.S. dollar deposits held in foreign countries were getting, that money is going to be repatriated back to where it came from, back to the United States, under the control of the Federal Reserve, and basically that is going to cause less credit available to the foreign banks at a time when they're going to definitely need that credit. So there's going to be a lot of money printing, which is going to then debase currencies, and ultimately, that is definitely not a good situation for the financial markets and for the average individual. Okay, so this is absolutely a serious problem. But I think one of the problems that scares me the most is really what Warren Buffett touched on, and he indicated that financial derivatives are weapons of mass destruction. Okay, and mass financial destruction, to be specific. And why is that? Well, because there's tremendous leverage, and they're so complex, these securities, that unless you know exactly what the hedges are across different asset classes, what happens in a situation when there's a market crash? Some of the hedges don't hold, and that's kind of what happened with JP Morgan recently. And I believe that if JP Morgan and some of the other companies are actually involved in securities like fixed income or corporate debt, because of the rapidity of the fall that I'm expecting, it's going to cause those hedges to become way out of whack to a degree that not even 20 standard sigma deviation event would be able to account for what's happening. It would be very similar to the standard deviation event that we saw in 1987. And that kind of event could bankrupt not only an institution, but create tremendous systemic risk, not just for the United States, but for the world, because most of the banking systems are interlinked. And I believe that Credit Suisse could be one of the big banks that could get impacted tremendously from a situation like that, as well as the regional banks. Travelers Corporation in the Dow, TRV, also looks extremely toppy at this point. So anyways, this is the wrap-up for our stock market crash warning, and brace yourself in the coming weeks ahead. Very dangerous times ahead indeed. And stay tuned to further updates and possible additional warnings at nakedswantrading.com, your one-stop shop for critical market updates. Thank you very much for listening to this call, and I look forward to having you on our future webinars. All you have to do to subscribe and opt in to get our updates on a regular basis is fill out your name and your email at the top, or lower down on our page over here, you could just click on weekly live webinar briefings. And also, just to let you know, when there is a webinar briefing, on the side panel over here, there will be a countdown bar that will tell you how many hours are left before the actual event takes place. So I thank you all for listening to this market briefing, and look forward to providing you with more briefs in the future. Thank you very much. This concludes our stock market crash warning issued on May the 18th, 2012. Actually, at this time, it's May the 19th, 2012 at 1:26 a.m., broadcasting live out of Midtown, Toronto, Canada. Now, just to let you know that our original alert of this initial phase where we are today of the stock market retrenchment off of the highs was identified on March the 30th with the canary in the coal mine being Apple Computer and thereafter Intuitive Surgical. 2 stocks over $500 ready to fall. Also the fact that Facebook and a lot of the social networking stocks did not behave well does not bode well for the rest of the market. I believe that what you're going to see in the magazine articles in the future following this market crash is that the top of the crisis, as usual, is usually depicted by the biggest deals that take place. And when you hear all the hype of a $100 billion plus deal, right at a time when a market is falling apart, it's never a good time to necessarily have an IPO. So we'll have to see what happens there, but dangerous times ahead. Thank you very much, and we'll see you again soon.